Wow, you win again!
Singapore just locked in money for 20 years at 2.4% per annum. That is as far out as the Singapore dollar bond market stretches. And 2.4% sits well below the 3.2% forensic floor this channel uses to judge every single income asset. When the safest, longest bet in the entire monetary system cannot clear the floor, it reveals exactly what absolute safety costs your retirement. Whether you have 20 years of accumulation left or are already drawing down your CPF, this market signal applies to you. The bond market itself is telling us that taking on duration alone does not buy adequate return. Only genuine risk-taking does. This is a reading of the master ruler every dividend stock and REIT gets measured against. And this week that ruler moved. Look at the headline numbers on screen. The Monetary Authority of Singapore just issued a 20-year sovereign green bond priced at 2.4% per annum. Set that directly against the forensic floor of 3.2%, and the final verdict becomes unavoidable. The safest, longest bond in Singapore fails to clear our minimum income bar. If institutional investors are fighting over paper that yields less than 2.5% over 2 decades, you need to understand what that implies for your personal wealth before moving another dollar. It makes no difference whether you are a builder with 2 decades of runway ahead or a draw actively pulling passive income today. The broader market is sending a clear, unequivocal message across every age bracket. Extending your time horizon does not automatically grant you higher yield. If you want returns that beat inflation and preserve your purchasing power, time alone will not save you. You have to underwrite real business risk. This sovereign green bond issue just reset the baseline for how we evaluate every stock call on the SGX moving forward. Let us break down the exact transaction mechanics from Wednesday. The Monetary Authority of Singapore raised $2.6 billion in 20-year green sovereign bonds that hit the maximum ceiling of its original target range. Institutional demand poured in hard, with a total order book reaching $4.6 billion. That is nearly 1.8 times oversubscribed. All that heavy demand let pricing come in 15 basis points tighter than initial guidance, settling at 2.4% instead of 2.55%. When big money shows up in size, the government does not need to sweeten the deal. Taking a closer look at the exact terms, this issue carries a coupon rate of 2.375%, priced at $99.60 per $100 of principal value, with final maturity set for the 1st of August 2046. These bonds replace the previous 20-year benchmark and directly fund Singapore's green bond framework. Specifically, the net proceeds are earmarked for major public clean transport infrastructure, including the upcoming Jurong Region Line and Cross Island Line MRT projects. It is prime, rock-solid infrastructure paper, but the yield reflects that complete lack of credit risk. For retail investors, MAS set aside a public tranche of $50 million. Let us be completely honest about what $50 million represents against a $2.6 billion total issuance. It is a drop in the ocean. For the average retail investor, this public tranche is not an accessible or meaningful asset allocation tool. Its true value to you is not as something to buy, but as a real-time, live market data point showing exactly where risk-free, guaranteed Singapore dollar yield is being priced today. Here is the complete Singapore dollar risk-free curve laid out side by side against our channel standards. Look down the entire list. 1 month SORAC at 1.23%, the latest 6-month T-bill at 1.50%, the 10-year Singapore savings bond average at 2.06%, CPF ordinary account at 2.50%, and this new green bond at 2.40%. Not a single guaranteed government-backed instrument clears our 3.2% forensic floor, let alone our 4.7% equity hurdle. Only CPF special account at 4% comes close. Every single capital safe option in the Singapore system fails the test. This failure demonstrates exactly why our forensic framework anchors its base floor to the CPF special account rate of 4% rather than low-hanging T-bills or SSBs. If we measured risk assets against a 1.5% T-bill, almost any poorly run company would look like a winner. By using a strict high-quality yardstick, we force every yield claim to prove itself before we risk a single dollar of hard-earned capital. Here is the headline forensic finding you need to take away. Locking your money away for 19.5 additional years compared to a 6-month T-bill bought you roughly 90 basis points of extra yield. That is it. You are taking on 2 decades of tie-up in exchange for less than 1 percentage point of extra income. And even after that massive jump in duration, the final yield still falls significantly short of our 3.2% floor. Why did this pricing land so tight? According to Cyrus Ning, senior research analyst at Bond Supermart, this 2.4% yield simply reflects where long-term interest rates have already drifted across the broader market this month, rather than a special discount MRS had to offer. It represents a fair market clearing price for 20 years of Singapore sovereign risk. But market clearing does not mean adequate for a retiree. It proves that stretching your holding period does not magically generate high income when underlying interest rates are low across the board. There is also a powerful scarcity effect driving these numbers. As Jerome Tay from Aberdeen pointed out, long-duration sovereign paper in Singapore is scarce and highly sought after by global institutional capital seeking a safe haven. Pension funds and insurance giants are legally required to buy long-duration bonds to match their multi-decade liabilities. Because these massive institutions must buy regardless of absolute yield, the demand squeezes yields lower than pure credit metrics alone would suggest, leaving retail buyers with thin returns. Think about this the same way you look at a fixed deposit at your local bank. When every depositor in town is lining up to lend money to the exact same rock-solid bank for 20 years, the bank has zero reason to pay high interest to attract your cash. With $4.6 billion of institutional money knocking on the door, Singapore did not need to offer a high-yield premium. Duration is only valuable when the market is starving for cash. And right now, for top-tier Singapore paper, the market is overflowing. So where does that leave us? A 2.4% yield is entirely fair for what it represents, which is 20 years of zero default Singapore government credit risk. But fair credit pricing does not make it sufficient for building wealth. It remains far below our 3.2% floor and nowhere near the 4.7% hurdle required for taking on REIT or stock risks. If you want income that actually supports a lifestyle, you cannot rely on time duration alone. You must take on real business execution, credit spreads, and equity risk. This setup proves that our 3.2% forensic floor is doing its job perfectly. If we calibrated our baseline against easy targets like T-bills, almost every weak stock on the SGX would pass. Measuring against a premier 20-year sovereign bond that global institutions fought over gives us a true standard. When even a landmark government issue fails to hit 3.2%, it tells you that every high-yielding headline on the market deserves a ruthless second look rather than a pass based on superficial vibes. The window closes fast. In this market, the difference between a true yield sanctuary and a dangerous yield trap is decided in a single trading session. By the time this analysis reaches a free subscriber, the entry window I identified has already opened and often closed. Iggy's elite investors do not just get the report earlier. They get it when the numbers still matter. You get zero-day forensic breakdowns, the full red zone watch list, and institutional-grade cheat sheets right at the moment the setup is live, not after the market has already priced it in. For $9 a month, less than a copy and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. Join Team Iggy using the link in the description below. Looking at the broader market context, the Straits Times Index has been consolidating just below its all-time record highs above 5,200 points, showing that equities are richly priced. At the same time, our risk-free curve shows that safe fixed income is also richly priced in its own way, with yields sitting well below our floor. When both stocks and safe bonds are expensive at the same time, finding genuine value requires extreme forensic discipline on every individual position you own. So what does this mean for you? It means there is no free lunch in Singapore dollar assets today. Any REIT or dividend stock that looks attractive simply because its yield is higher than a 1.5% T-bill or a 2.4% bond is passing a dangerously low bar. To earn a place in a resilient retirement portfolio, an asset must clear our 4.7% hurdle and pass strict balance sheet stress tests on its own fundamental strength, not merely look decent next to low-yielding safe paper. If you are still in your wealth accumulation phase with years of runway ahead, this data carries an important lesson. When safe money yields low single digits across the board, taking calculated, well-underwritten risk becomes the only effective way to build real purchasing power over time. The forensic floor and hurdle exist so that whenever you step out on the risk curve, you know exactly how much extra yield you are being paid to take on that business exposure. For those already in retirement drawdown, a weak risk-free curve raises the stakes significantly. The temptation is to reach for dangerous, high-yielding trap stocks to cover daily living expenses. That is sequence risk in plain terms. A bad pick during your early retirement years can permanently destroy your capital base before you have time to recover. Our floor and hurdle standards force you to apply rigorous analytical filters before committing your money, protecting your principal when you need it most. Looking ahead, keep your eye on two critical developments. First, monitor the Monetary Authority of Singapore's Green Bond Pipeline, which targets up to $35 billion in public sector issuances through 2030, to see if new supply eventually forces yields higher. Second, track the broader drift in long-term interest rates. A sustained upward move in global benchmarks would represent the first true test of the floor and hurdle levels our framework has maintained throughout the year. 20 years, backed by the Singapore government, and heavily oversubscribed by major financial institutions, yet still falling short of our forensic floor by a full percentage point. Capital-safe SGD instruments do their job of protecting principal, but safety alone cannot generate the returns required for retirement income in today's market. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The market window on these yield differentials closes quickly, and waiting for public headlines often means missing the entry pricing altogether. Members of Iggy's elite investors receive real-time updates and complete balance sheet audits the moment market dislocations appear. If you want to stop guessing and start analyzing with institutional clarity, hit the link below and join us today. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.
Unlocking the future of finance. Subscribe for more.